taxes allocated to higher income tax filing units, people. That is the government's assessment, best assessment of the overall impact of this bill. And why is it that it raises money from the poor to pay for the tax cuts for the wealthier? It's mainly due, and if you go to another report, this is the Joint Committee on Taxation report that was explaining some of the impact of the elimination of the individual mandate. The Senate version of the bill eliminated the individual mandate's tax. So it's a tax provision, so it can go into this bill. And by taking away the tax, it basically means that people are no longer forced to buy insurance. The JCT estimates, though, that deficits will be reduced, and therefore you can pay for the tax cuts by about $318 billion, because it eliminates the penalty associated with the mandate. So how does this raise $300 billion? I was really confused at first when it came out and it scored so high. But this is their explanation of how it raises that $300 million. It says those effects occur mainly because fewer people are enrolled in Medicaid or non-group health insurance through these markets. Therefore, they're less likely to obtain insurance. And the resulting increases in premium cause more people, oh sorry, I'm having a hard time reading the small print. I'll just explain it in real English. What happens is healthy people drop out of these markets. When the healthy people drop out, it costs more because there's more claims on average in the pool. The prices of the premiums go up. The low-income people can't afford the premiums, so they don't buy the insurance, and the federal government doesn't have to pay the subsidies, and because they're not signing up, they're not being directed to Medicaid programs, and so the federal government saves money on the health care costs. Though there's a little bit of a bump, this goes on to say, not in this quote, that the Medicare costs are expected to bump up a little for hospitals that serve low-income people. So if you're a hospital or a healthcare provider, I think this may be the most significant part of the tax bill for you. It is anticipated by the JCT that that your costs of the uninsured will go up. So that's potentially a significant thing for the organizations that are serving the low income. And then that chart, you probably can't read it. It'll be in the slides that are provided to you later, but it shows graphically how the amount of the subsidies that are lost at the low income levels offset are greater than the tax cuts. And so that is unfortunate, but that's how this got paid for. So next to moving on to more direct impacts on charitable organizations, on your tax stuff, and not just your operations. There we go. The first thing that folks are typically really concerned about is charitable contributions. That was all the talk at the time this was going through. What's this going to do to charitable contributions? And I think pretty much everybody agreed, and people are afraid that it will reduce charitable contributions, not because the deduction's not there. The deduction is still there. However, the combined effect of the drop in the rate and the increase in the standard deduction means that fewer people are going to be claiming itemized deductions, and therefore fewer people are going to be feeling the incentive value of that deduction. Let me see here. I'm sorry, I have misplaced my note on that slide. Sorry. Well, I will just walk through it. I'm going to have to walk down here. I've got my mic on here. Sorry about that. Want to walk through? There it is. There it is. It keeps the deduction. We did not get a universal charitable deduction that a lot of organizations lobby for, but we did keep the charitable deduction for those who itemize, which is now anticipated to be about 5% instead of the third of the population that used to itemize. It also reduces or limits a number of the other itemized deductions. So the mortgage interest, the state and local taxes are shrunk. One thing to note, again, for those of you particularly, medical expenses are a big issue with the older population sometimes. For this year only, the itemized deduction there is kept and the threshold is lowered to only 7.5% of income. I think the hope is that maybe this could get extended somehow. But otherwise it goes back to the 10% floor that it was at. And it also eliminates the P's limitation, which was the haircut on all itemized deductions. What does this do to your organizations? I think there's concern, and with good reason, that to think that perhaps without the incentive value being felt by people, that contributions would decrease. And let me just borrow an illustration from a friend of mine, Alex Reed, another tax lawyer. He has this illustration of how this all works together, and I want to explain it just to make sure that everyone understands sort of the interplay of the itemized deduction and the other deductions and how this impacts. And his illustration goes like this. Imagine that the incentive is a cool breeze. This charitable incentive is a cool breeze. And you can usually feel it, and it can encourage people to give. And the threshold for the itemized deduction, so the standard deduction is like a fence. And you only feel that breeze if you get over that fence. So people that might have itemized when the standard deduction for a couple was $12,000, they could see over that fence. They had their other deductions and they could see over that fence, and they felt the breeze and they could give. It's like the mortgage interest and the state tax. Those are like boxes. Those are like boxes you can pile up so you can stand on them, so you can feel the breeze coming over the fence that incentivizes the charitable contributions. Those boxes have shrunk. So it's harder to pile up boxes to see over the higher fence. I like that illustration. It helps give a picture of how this impact works. And certainly people will still give, even though there isn't a tax incentive to do so. But I think every study I've seen does show that there is an impact when rates go down and the itemized deduction is not in play. The question is just how much does it go down. So that's something that your organizations will find out and will be watching to see. I don't think anyone in Congress wanted to hurt the tax-exempt sector. There was a lot of talk of wanting to help the sector and not wanting to hurt the sector from both sides of Congress and both sides of the aisle. I think, though, that the solution that was put forward, the universal charitable deduction, was just too expensive. And so what we did get was a nod in the direction of charitable giving, and we got again, this page is missing, sorry. We did get a temporary increase in the threshold for cash donations to public charities to 60% of income instead of the usual 50%. Another nod in our direction, it eliminated this one was actually, the second one was aimed at colleges and universities that have sporting events that are heavily attended. It eliminates the deduction for contributions if you get in return the right to purchase seating. You have to be careful of that one because it's not that your deduction is reduced, it is eliminated entirely if you get this right to purchase seat. And it doubles the amount that is eligible for exclusion from the estate and gift tax, so that, again, it's similar to the annual exclusion. It will make it harder for folks to feel the breeze of the incentive to donate at death. Okay. So, this is back. Sorry about that. Moving on to a number of issues. This is about the taxes on the tax exempt sector. This is the last one on the page that's missing, I'm sorry. This is another way that financed the tax cuts for everybody, is through some new taxes on the tax exempt sector. And I put it that way knowing that that is a little inflammatory, but I am personally offended for the tax exempt sector, because this sector, your organizations, are tax exempt for a reason. You do things for the community. You serve our country and our community and the folks in most need in our communities. And that's why you get your tax exemption. You have to meet a fairly high bar of charitable activity to get that tax exemption. And there are new taxes that apply to you in UBIT, in executive compensation, and one more. It's on the slide. We'll talk about them in depth. Talk about the UBIT first. There's two parts of UBIT. Two parts of the UBIT, and the first one is the fringe benefits. I'm going to talk about that because that can impact every single tax-exempt organization. It's still mind-boggling to me that we're talking about UBIT here, because number one, the fringe benefits you pay to your employees are not unrelated to the tax-exempt activities that you do. Oftentimes it's not related to business activities, because these employees may be just doing your charitable activities, and it's not even income. So I'm not sure why we have a tax on the related compensation paid to employees doing your charitable mission, but that's what we've got. This is a new provision, 512A7, that increases the UBIT amount for each organization that pays certain fringe benefits, common fringe benefits, to their employees. It doesn't matter what the employees are doing. It's a tax on the amount paid. The specified benefits, and specified in the statute, are qualified transportation fringe benefits, any parking facility, any amounts paid or incurred for parking facilities used in connection with qualified parking benefits, and on-premises athletic facilities. So those little gym workout rooms, the on-site gyms for the employees, that's what that's talking about. And the qualified transportation fringes are like the metro passes. And all of these benefits, what they have in common are they are excluded from the employee's income under Section 132. The reason this is in here is the idea advanced, at least for it, is to be fair and to have parity with taxable employers. When I know. So, in dropping the corporate rate, you had to pay for that. That was the biggest cost here. You had to pay for that. It's paid through myriad ways. But one of the ways that they were like looking for change in the couch cushions, right? They expanded the tax base for corporations in a couple of ways, and we'll touch on a couple of them, but one of those ways was they looked at these benefits being paid to employees that are excluded from the employee's income and that taxable employers deduct, and said, well, hey, you know, the cost of that gym, that's really, I'm guessing they're saying, well, it's income to the employee, but we don't really want to tax the employees. We're giving this big cut to the corporate folks. Let's make them pay the tax on that, because nobody else is paying tax on it. It's excluded from the employee. And if the corporation doesn't want that, so now it's made non-deductible under Section 274. The on-site gyms or the transportation fringes or the qualified parking, well, not the qualified parking structures. It's not entirely clear what happens with the qualified parking structures. These transportation fringes, and the one that's I think most ubiquitous is the metro, and those sorts of the help commuting in, particularly in urban areas, that is now non-deductible for corporations. And corporations can either choose to just exclude it, and so their taxable income goes up, but their tax rate came down, so they have the money to pay for it. Or they can tell employees, too bad, so sad. We'll just give you more money and you can pay for it yourself, or we'll tax you on the value of that benefit. And so, to be fair to the tax-exempt sector, you as employers are subject to the same thing. But we can't just deny you a deduction, Jan, you don't pay tax on your net income. What they can do, though, is include it in the unrelated taxable business income that you have to pay tax on at the corporate rate. No, that rate came down. So for those of you with UBIT, the good news is you're no longer going to be paying 35%, you're down to 21%. But you got more to pay on. And these fringe benefits, this is something I want to get out to everyone. This is really a big provision, even though it's probably small dollars, because it impacts every charitable organization that provides these benefits. And in many cities, I'm not sure here that it's required, but in some cities like New York or San Francisco, there are some city and local requirements to help reduce congestion that require this. So organizations that may never have done a 990T before, may never have had UBIT before, are going to have to figure out this new form and figure out how to pay for it, because it will increase the cost of doing your charitable activities. Some things to note here, it is hinged on, there are two different provisions. There's the one in 512 that says you owe UBIT, and then there's one in 274 that says taxable employers, you don't get to deduct it, and they're tied together. Tax exempts only owe tax if the taxable employer would have not been able to deduct it. But there's that tie right in 512. Okay, so what does that mean? We got a couple of things. So it's a little interaction, and then this is one of those places where things don't fit together very nicely. And there's a little ambiguity here. I'm not giving you all legal advice. There's a few things that are clear and a few things that are very unclear. For those on-site gyms, there's a provision in 274E4 that allows taxable employers to still deduct. This was not taken out. The House would have taken it out. The Senate didn't take it out. We got the Senate's 274, so there you still can deduct on-site gyms if they meet non-discrimination requirements. They're not just for the executives. Then by correlation, taxable folks, you don't have to pay tax on those gyms, provided you meet the same requirements in 274E. However, so that's clearly out. The transportation Metro Pass is clearly not deductible, clearly taxable. Parking facilities, not entirely clear. Over in 512, it gives instructions to Treasury saying figure out how to allocate the depreciation on parking facilities and athletic facilities between for employees, and allocate those costs so that it looks like the intent is to tax them. But over under 274, not really clear whether it's non-deductible. So that's an area that there's a little lack of certainty. I think we really, as a sector, need to get vocal and ask for guidance. It's imperative that we get guidance on this, because you've got fiduciary responsibilities in two places here. Of course, you need to be tax compliant. And my experience is the tax exempt sector tries to be ultra tax compliant, to pay the absolute last penny that might possibly be due. But that means that because if you overpay, you're never going to see that again. So there's a question there on parking facilities. If you have parking facilities, talk to your accountant, talk to your lawyer, figure out, and get vocal here. I think that's, my bottom line of this whole presentation, the reason I come up here is because you people really, really matter in this process that's going to happen right now. The next step in this is regulations. I noted it briefly, but because this statute in particular has so many holes, Treasury is going to have a big job to fill those holes and to get out guidance. And the way things work at Treasury and everywhere else is sort of squeaky wheels get grease, and folks that are sympathetic get listened to. And you all are sympathetic. You are doing good work in good communities that people care about. Treasury's not going to know what kind of guidance you need unless you speak up about it. And there are a variety of ways to do that. You can send in letters to Treasury and the IRS, and if I can provide some information that if you want to do that directly, you can talk to your elected representatives and encourage them to let Treasury know what the priorities are. But I think getting guidance for the tax-exempt sector could easily fall through cracks. And unless our sector sort of mans up and asks for the guidance that we need, and not just, oh, please, you know, when you get a chance, we'd really like it if you give us some guidance on this, but demand the guidance that your beneficiaries need. Your charitable folks, the programs that they have will depend on the guidance that you get and the taxes that you pay. So you should feel entitled to guidance from Treasury about these provisions that we're talking about. And even though this is a little one, it affects a lot of folks. And it seems to me that the compliance cost, the burden on some small organizations to get someone to help them to fill out a 990T and to put this in is going to far exceed whatever small amount is collected. And I mean, perhaps there should be an administrative exception for amounts that are under, say, $1,000. There are ways that you can ask for help with this, and I would encourage you to do that. Okay, off my soapbox, I'll continue with the details. Separate calculations for UBIT. This is also a big one. We put all the big ones up front in case we run out of time. Siloing of the separate trades or businesses. Currently, if you as a tax-exempt organization have multiple unrelated, did it not advance? Sorry. There we are. If you have multiple trades or business, and one has a loss and one has a gain, those get netted up before you tax just the net gain or loss on, or net income on all of your unrelated trades or business, and this is just like for-profit businesses, right? You may have the loss leader line of business, and you may have the really profitable cash cow line of business. You get taxed on your overall net income. That changes for tax-exempt organizations. With UBIT now, you need to calculate your net income for each separate trade or business separately. And then at the end, you add it all up, but you don't offset the losses with the gains. That's a significant issue. I think it was aimed largely at colleges and universities that have a lot of different things, but what may not have been considered is how does this impact investing? And the big question floating around that we don't have an answer to, again, ask for guidance on, we're going to have to ask for guidance on, is if you have income flowing up through investment partnerships and separate, how do you deal with that? Is it separate lines of business for each investment? Is it all one investment? Is investment all one trade or business? I think that would be a great answer. That would be one to ask for in guidance, but that's a question. Okay. Executive compensation, did it advance? Yep. Okay. There's a new excise tax in 4960 on executive compensation. And there's a few things to know there. It's at 21%. It's an excise tax, and it's on compensation of executives in excess of $1 million or on excess parachute payments of any amount. They don't have to reach the $1 million threshold. Here again, the idea was being fair with taxable employers, where on the taxable side, you've got Section 162M, and that limits the deductibility of compensation paid to executives at publicly traded companies, and so they can't deduct amounts over $1 million. And so, of course, your organizations are just like publicly traded companies, right? And you all don't compete in the talent marketplace with non-publicly traded companies who are not subject to that limitation on executive compensation. I don't get it. I don't see how this is fair at all, but you're stuck with this for now. It's applicable not only to charities, but to all 501A organizations and farmer cooperatives. governmental instrumentalities that have excluded income under 115, and political organizations, 527s. Covered employees, important thing to note here, it's the 5 highest compensated employees, and once you're a covered employee, you're always a covered employee. So if you were one of the 5 highest compensated in 2017, or any year going forward, you remain a covered employee. And it's only the covered employees' compensation that you look at. You look at compensation paid not only by your organization, but also related organizations. And compensation, I'm not going to spend much time on this, but it includes everything you're paid and amounts when they are no longer subject to a substantial risk of forfeiture. I'm not going to talk about the excess parachute payments, but that has to do with a payment that is made on the condition of separation. So when someone who leaves gets paid an amount, a lump sum amount. But I want to move on to the excise tax on endowment income. This is one to watch and one to be wary of. Right now, it is only on certain colleges and universities. If you are a college and university, I'm sorry, this bill has a special place in its heart for you. This one, there was a lot of iterations. It ended up with a 1.4% excise tax on the net investment income for colleges and universities if they have at least 500 students, more than 50% of whom are in the United States. Query what sympathetic organization had its students outside the United States and got that in. It's not a public institution, so state colleges and universities are outside of this for now, and had assets in excess of $500,000 per student. The real sort of crazy thing here is that it includes the income and assets of related organizations when you're assessing whether you meet that $500,000 per student threshold, and when assessing the income that's subject to tax. So if you are a small college or university, and you get payments from a supporting organization, you are supported by a really large supporting organization, maybe they only give you $10,000 a year for a music award, but they have $3 billion that they give to other organizations in the community. Watch out. Because this, by the terms of the statute, will look through to all of their assets in determining whether you have $500,000 per student, and looks to their income when determining your tax bill. Same thing with all controlled organizations, whether or not they're taxable or tax exempt. So that's a trap for the unwary. If you are a college or university, you should look at all of your related organizations and sort of figure this out fairly quickly. There's a couple of more details about the number of students. Moving on. Sorry about that. Told you, I'm just getting used to these. A couple of other provisions. These are some provisions I wanted to mention. This is the first one on here is a good thing, 170 F8. Some of you may remember a couple of years back there were some proposed Treasury regs that would have given effect to 170 F8, and they sort of put out there that we've always said that this provision that allows for donee organizations to report donor contributions so that donors can get out of the substantiation requirements. That has never been in effect. Treasury has never put out regs until a couple of years ago. They said, well, if a few donors who are in court now demanding that we effectuate this provision, if they get their way, then everyone is going to be asking charities to do it on their 990s, and we're going to have chaos. So the Treasury Department put out proposed regulations saying that, well, if we did do donee reporting, this is what it would have to look like, and by the way, you'd have to collect Social Security numbers. 30,000 of you wrote in, and those regs were promptly withdrawn because everybody thought donee reporting was a bad idea. Thank goodness, The court also saw all of that activity, saw those comments that you brought in, and the court found that, no, this provision, you can't just up and use it yourself without Treasury regulations, so that donor lost in court. And Congress cemented this so that none of us have to worry about it in the future by eliminating that provision of the code. So that, again, is evidence of the power of your voices. If folks had not written in about that, folks wouldn't have known how the sector felt, and changes in policy wouldn't have happened. Another thing I want to mention here that I don't have a slide about, it may be of interest to some of you. There is one little silver lining that I've been able to find, and that is a new tax incentive for taxable investors to invest in distressed communities. It doesn't really impact, it doesn't say anything in this provision about charitable organizations, but I expect that the folks that are most interested in distressed communities are us. And this would draw more resources by providing tax benefits to individuals to roll over gains from other investments into investments in these qualified opportunity zones. So if you're interested in that, I'm more than happy to talk about that more. And I just had a couple of slides at the end, and I understand that these slides will be made available to you so you can peruse them after. 2 slides of near misses. 2 slides of things that could have happened that were drafted and were proposed but didn't. And most of them, there are a few of them in here that would have been helpful to us, things like simplifying the private foundation excise tax at a flat 1% or some percentage. But most of these are relatively negative. If you see them on this list, know that these could come back. Once something is in legislative language, it sits on a shelf, and folks can pull it off the shelf to help pay for the next thing. Also, all the provisions that are in there, and if you think, ooh, dodged a bullet because I don't have 500,000 assets per student, you know, you could be next. If tax exemption doesn't mean you don't pay tax on the endowment assets, what does it mean? And someone said, well, first they came for the colleges and the universities, right? It's very, very easy for me to think that that can expand, both in the colleges and universities world. Oh, well, you know, 500,000 per student, maybe 400,000 per student, and hopefully endowment assets grow over time, so if you're not there yet, you will be. But what about DAFs? What about community foundations with endowments? Those are just big pots of money sitting there. And the only rationale given for taxing the colleges and universities is we don't like them. I mean, it wasn't said quite like that, but there were some comments about, well, I don't like some of the thinking going on there and some of the liberal thoughts that are coming out of most of these universities. So, come on. We're the tax-exempt sector, and we haven't played that way before. I don't think actually the majority of Congress felt that way particularly. I think they were just trying to find revenue. And this was an easy spot for it. And the easy spot next may be community foundations or private foundations. I think this is a time where we really need to engage on taxes, but this is where our sector is regulated and our sector is grown, and our sector, it's the rules under which we live. And if we have a voice in shaping those rules, that's the environment we live in, and that affects the resources that we have to do our charitable missions. So the rules we live under affect us just as much as the rules for giving our money out to our beneficiaries, and we should be looking at both of them. And if it's something in this bill, we're out there to say, okay, we are going to raise the rate to 50% on people that are living in poor areas, every one of us would have jumped on the front line and said, no, that's not fair. But if you do it indirectly by cutting off resources to the very organizations that serve those people, it's just as important for us to be involved in this dialogue and for you all to put comments in and to suggest to Treasury, ways in which you can mitigate the harm to your organizations. You all have a lot of power in this debate, so I encourage you to use it. Thanks.
Hi all. Morning. All right. As mentioned earlier, my name is Robin Garvey. I'm the Vice President of Philanthropic Services at Lee Foundation. I'd like to thank Ruth for coming and going over what is somewhat confusing stuff going on, but also how big of an impact it could have on our field. A little bit of background, Ruth was actually also on the Treasury team that helped with the Detroit bankruptcy. We all owe her thanks for all the work that she did behind the scenes on that. So we've had a good relationship over the years on a lot of things that affect charity and our community. I'm going to ask the first question because someone actually sent this question in before we even sat down today. So for that reason, I'm only going to ask the question, and that's in respect to the state tax going up, the exemptions. One of the questions that was asked was, is there any change in step up in basis? So for those that don't understand this, this is when you die, you get a step up in the basis, the cost basis of your property, so that then when you sell it later on, you have a reduced capital gain. And have there been any changes to step up in basis?
I don't think so. I wish you'd
no.
to that.
So,
I don't spend my time on the individual side, but my impression is that all they did was double the thresholds and that nothing else changed with the estate tax. I think there was a lot of desire to appeal it. That didn't happen. I think it was too costly. But I think just changing those the threshold amounts is going to be significant. Yeah, but the step up in basis stayed the same.
Just to give you an idea, the change in the amount of exemption for estate taxes, studies would indicate that the estates that are now exempt from federal estate tax represent about 60% of charitable bequests that are given every year. So if that incentive is gone, if that breezes away, then you could possibly see as much as a 60% reduction in charitable bequests, which is one of the reasons of that exemption. The income tax. We talked a little bit about this breeze going away and how that might impact charitable giving. Can you comment on what is the likelihood of how sizable that is, and if there's specific segments of the taxpayers that may feel that effect more than it passes on to the nonprofits as to what they may see as a reduction in the charitable giving coming forward?
Yeah, I think it really depends. I've seen studies that go all the way from 0.2% to larger to 2 or 3%. It's hard to tell. There are some studies out there. I think isn't it Lilly, Indiana did a study that estimated the amount. I think it's very variable. It's hard to say exactly what that will be, and it will impact different organizations differently. I think organizations that tend to get lots of little donations. Sometimes people don't itemize that. Sometimes people that get donations from folks who are below the standard, who are below the standard deduction fence. Did it go?
There you go.
Here, I'll put it over here.
We're having a little, we're all set?
I can talk loud. If your organization gets a lot of donations from a lot of little donations, maybe those were not being itemized anyway. But my understanding is that a lot of organizations that even if their donors don't itemize, the fact that the itemized deduction was out there and that one might be able to get some sort of tax benefit was a psychological impact for giving, even at those lower income levels. So it's really, really hard to answer your question with any sort of precision. I think certainly at the higher income levels where you're sort of figuring out how much can I give in the tens of thousands and higher gifts, the expectation isn't that those would go away so much as those might be reduced. And so it's really hard to to estimate across the spectrum. I think you need to look at who are your donors and how might they be impacted by the changes. And then start thinking about, I think this is an area that it's just really fascinating because it has every bit as much to do with people's behavior, people's psychology, as it does to tax incentives. And it's interesting to me to watch the growth in fundraising techniques like GoFundMe. And some of these raising $2 and $3 from bazillions of people goes on without a tax deduction incentive all the time. But the large gifts, I think, is where you're going to see probably more of an impact.
So this is where we get into the tax geeks. Sorry, we'll talk about what's called elasticity. Okay, and if you're not familiar with what
This is, sorry. Okay. Tell you what, we're just going to switch back and forth. There's something called state tax or tax elasticity. And what tax elasticity is basically when there's a change in the after-tax benefit of a gift, what is the change in behavior? Okay? And what the studies have indicated is that if there's a change of approximately 1% in the benefit, after-tax benefit, there's a 1.2 change in behavior. Okay? So when we saw the Michigan tax credits repealed a few years ago, they were 50% tax credits for gifts of like $200 or $400. Remember those? That was a 50% credit. 2 years after that, we were doing studies, and what we found is that those size gifts in the state of Michigan went down by 63%. Okay, for those charities that were active. So if, as Ruth says, you see a 4% change in your after-tax, your tax bracket at a higher income level, even though you can still itemize, will that change behavior by 5%, 1.2 times 4? That's where we're starting, what is that going to be, that psychological effect? Okay. The other thing I think that we talked about last night was this increase in the standard deduction, is that you have a lot of people that used to itemize. Think of this, you're going from 30% of the population itemizing now to 5%. Well, if they're not getting that breeze in the face, those ones that are now going to suddenly not itemize, are they going to still give, or will they give at a lower level? Will they give at a higher level because they have more after-tax income? And that's kind of rough.
That's been argued. The other thing that might make sense for some folks that are going to be really close to the line, they may bunch. And this has been noted by economists also in some studies, that if their itemized deductions are just under the standard deduction, it might make sense for them to do charitable deductions every other year, or perhaps to fund a donor-advised fund with a big old gift one year and then send it out over the succeeding years for charitable operations over time. Because if you get over that fence, if you get over that standard deduction amount, then every dollar is deductible. But it's just getting over that fence is much harder now. So I think also that the liquidation events, those have always been important charitable giving times. When someone has a business and they sell it, or when there's some asset, there's a house sale, there's always, when there's a liquidation event, folks can be charitably minded, and that's a time when maybe the standard deduction fence will be exceeded.
So one of the things we were having a conversation about last night was, in this group, if you're a nonprofit that really relies a lot on maybe those $2,000 to $5,000 gifts that people, those are a lot of your bigger donors, that may actually cause a problem because they're the ones that maybe are not going to be itemizing in the future. So this goes back as fundraisers. You need to talk about your mission. You got to remember people that you're an important part of the society, that you're serving these populations that because of maybe lack of health insurance now and things of that nature need your services more. So it's important for you to talk about what you're doing to benefit the community and make sure that you have that conversation because the tax incentive may not be as high as it is. So
that's true. And the tax cuts, there's a little spot right in the middle of the tax brackets that seems to be getting sort of less of a cut. And it's that 2-income professional where the tax, right around I think in the $300,000 to $400,000 income, I think those folks are not seeing as much of a cut as the way that the brackets ended up working out. So there may be a rub in there, actual tax increases for some, because depending on where they are, the state taxes that they it just works very funny, and it's hard to estimate. So what I would encourage you to do is think about who are your donors and maybe play out a few scenarios and try to see what they're seeing.
Since we're talking about tax rates, one of the questions was, so what's the effect on corporate giving? Because now the corporate tax rate has gone from 39.6 down to 21%.
Yeah, I don't know that corporate charitable deduction has ever been that big of an incentive. Maybe it is for some organizations, but what I've found more is that a lot of corporations are treating contributions as ordinary and necessary business expenses because their name gets out in the community. And there's a lot of sort of the goodwill advertising type of activities that corporations do that arguably can fall under a marketing budget as opposed to a charitable contribution. But yes, strictly speaking, the 10% limit on charitable contributions stayed the same. The incentive value, if it was incentivized by wanting to lower taxes, the tax rate drop is significant, 35% top marginal rate down to 21%. That's a significant drop. So maybe there would be a somewhat less incentive effect, but certainly there is more income. There is less tax being paid, and there is more of an opportunity to give from the corporate coffers. And you're seeing some of these corporations giving bonuses to employees. Query whether some of these corporations should be giving benefits to their communities.
Yeah, and I'll actually talk a little bit of an airplay. I'll take this one. Is what's not been talked about is this deduction for taxable income for pass-through entities. Okay, so this is like, let's say LLCs or limited partnerships where you have partnerships, you have pass-through income to the individual, which meant that it was taxed at my individual rates. Well, my individual rates just went down. I'll credit this, so an attorney up in Birmingham brought that to me, is that most of my income is through a pass-through entity, my LLC or whatever. My income, I just got a 20% reduction. So my income that was $100 is now $80 already. Now on that $80, I'm paying at a lower income tax rate. So that elasticity thing about the after-tax cost has been compounded by the fact that 20% of my income is no longer deductible, or no longer taxed in general. So again, how is that going to affect business owners on their individual giving, because they're going to have more of their income not subject to tax? And that's one of those impacts that we haven't really, we'll have to see how it flows out in the end, but it is an interesting concept that they'll have an even larger, less breeze. More of the breeze is going away.
But more money in their pocket to potentially give.
That's the counter argument. Okay? We mentioned briefly P's. Can you explain P's and then also how that might we actually talked last night a little bit about that may actually be a benefit for some people, that P's is eliminated for charitable giving.
Well, Robin is actually even more of a tax geek in this area than I am. The P's limitation was the overall limit on all itemized deductions. It was a haircut that would take off 3% of your itemized deductions across the board if you hit certain thresholds. That is wiped away. So there is no more haircut on all of your itemized giving. And what well, yeah. Robin, you explained it better.
Okay. Basically what this is my opinion, affected your deduction for your Michigan income taxes. Well, now Michigan income taxes or local taxes are now limited to $10,000 already annually. That's a new change. The box is shorter. Okay. So, but what in a day, if you made a charitable gift, because the P's reduction was really applicable to your Michigan income taxes you had to pay regardless, all of your charitable giving was in fact fully deductible. because Pease was being absorbed over here, okay? Where it impacted people is in states that didn't have an income tax, Florida, okay? Florida, you made a charitable gift, Pease applied to your charitable gift, okay? Well, now that Pease is eliminated, people can make a charitable gift and get the full value deduction without worrying about it being reduced. So anybody that here that has a Florida-based taxpayer that makes charitable gifts to them, well, we all have them, all right? All the snowbirds down in Florida, okay? They now have an incentive in that they can make a gift now and not have Pease apply to their charitable giving like it did in the past. Okay, so that is a small win in some respects for charitable giving. Okay? A question that came up is on the, going off the income tax rates and all for a minute, is the applicability of the excise tax on endowment funds, okay, and investment earnings. Is that applicable only to college and universities, or does it apply to other educational institutions as well?
Well, it's spoken about colloquially at colleges and universities, and there's a link in the statute that defines it. I believe it links to a department. It's another place in the statute, so I think it's just colleges and universities linking up there. I could look in. I haven't dug down on that particular piece, but I think it's just colleges and universities.
And that's my understanding of it as well. This has gone through several different variations over the last several months. At one point in time, it did apply to public universities. So you can see U of M having to pay this all. They got excluded in the end.
It would be very easy to take it right back out again. Just to give you an idea of how this process really works. You know, the medical expense deduction that we had in there, it's at 7.5% this year and 10%, that started as a 2% floor. And it's really easy, once you've got something in the code, just to, let's take that 2 to a 3, let's take that 3 to 3.5, let's take that up. In the college and university endowment tax, now that endowment tax is in the code, it'd be very easy to take and strike through that line that says, you know, who's subject to this, and it's at the colleges and universities. There's another line that says that are there's a reference in there that says basically not public universities. It gives, just strike through that, boom, it's gone. And it applies to all colleges and universities with endowments that way. You can easily take that $500,000 and make it $250,000. In fact, they did that over the bill drafting process. It sort of went up and down, and they sort of shaped it.
At one point in time, it was $100,000.
Yeah.
So you take full-time employees by $100,000, it's a much lower threshold before that tax kicked in. Okay. And so, yeah, these are variables that could change. And I think, as Ruth pointed out, the concern is that will it get expanded to other universities or schools? Will it get expanded to foundations or public charities that have endowments? It's kind of like that slippery slope. We don't mean to be the sky is falling, but these are the things we do have to worry about. There's a question up here, if we could bring a mic, please.
You could repeat it. What is a way for us to track what bills are being amended, changed, proposed that have to do with nonprofits? Because you say this can be changed easily. How do we keep an eye out for that?
Oh, that's a great question. I have a tracking service that my library gives me. Introduced bills, there's Congress.gov has a continual tracker. I'm not sure what in your community, if there's someone that monitors this frequently.
And I would say here in Michigan, the couple groups that you should belong to is, if you're a foundation, Council of Michigan Foundations has an extremely good government relations office. Nationally, with the Council of Foundations and also independent sector. Independent sector represents both both foundations as well as the nonprofit groups. So they're monitoring all of this for all of us, and they have a good, and then also locally would be the Michigan Nonprofit Association. So all of those groups I would highly encourage you to be members of and talk to them, and they will send out legislative alerts or here's what's happening, things of that nature. And by the way, how long does it take to pass regulations for something like this?
Well, regulation, how long has it taken to do donor advised fund regulations?
They're not done yet.
And that was legislation that was passed in 2006. It's been over a decade, and there are no regulations yet about donor advised funds. And that is my biggest fear about this, is that we won't And honestly, people come to my office and say, you know, it would be really helpful if you give us some guidance about what to do about bifurcated chicken dinner payments. And they started coming in and doing that when I got there in 2010, and folks have been doing that for a couple of years. I think, having been on that hall in Treasury, I was the only person doing tax-exempt organizations. Next to me was someone who did corporations, and down the hall was someone who did individual issues, and somebody else did partnerships. And when their people, they would all laugh at me when my people would come in and talk, because they were so nice and so earnest. Get
mean, people, get mean.
But when the folks that were coming in standing up for corporate provisions, and when a corporate bill would pass that did something that corporations didn't like, they marched in and said, how dare you do this? You need to fix this, and this has to be fixed now. And they had a sense of urgency and of entitlement that I think our sector needs to grow. We are standing up for our communities and our beneficiaries. And we have every right to guidance, just the same as those corporations. And it doesn't matter if we have fewer zeros at the end of some of our things. So I think we ought to be in there, and we ought to be asking for guidance quickly. People have to work together. I give a shout out to the Council on Michigan Foundations. You all are so blessed to have this organization focused on you. I can tell you that their director, Rob Collier, is one of the few people that really understands how stuff works in Washington. And I'm sure he understands here in Michigan as well. He was instrumental in getting the country guidance on impact investing that will bring millions of dollars to charitable causes throughout this country and the world. That notice that we did when I was at Treasury in 2015, people call it the mission-related investing notice, but it's basically the one that gave some clarity that private foundations could make investments that both furthered charitable purposes and made a decent return, and gave sort of the green flag for doing some impact investing and getting resources into places that it may not have been flowing to. It would not have come out but for Rob's continued persistence in asking for that guidance that then I could take and use to get that done.
A couple questions on the fringe benefit aspects. One, I don't make $1 million.
Again.
But there are nonprofits that do.
Yep.
So ones that are typically going to be affected by this are going to be like universities and also nonprofit hospitals. Start thinking about the surgeons and all that may get higher compensation and stuff. So it does impact the field.
It impacts also investment officers. A number of times, if you have a large endowment and you bring that investing function in-house, instead of paying $4 million a year to your outside investment counselor, maybe you brought her inside and you're paying her $2 million a year. You're saving $2 million by bringing that function inside. Now you're going to have an additional drag. The other thing I should probably have mentioned earlier, and I want to mention on this, is people have questioned the interaction with 4958, for example. 4958 still applies. You can't pay more than reasonable compensation to anyone. But there are some folks, some of the executives, and hospital executives, where you're competing with for-profit employers for the same talent. Doctors, cardiologists. Do you really want the one that only can get $200,000 while all his buddies are getting $1.5 million? Kind of wonder why. You don't want tax-exempt organizations to only be able to get the cheapest folks, and that's never been the law. 4958 prohibits excessive compensation, but that's based on what is paid by other employers for similarly skilled individuals. That still applies. So this tax is only on reasonable compensation. But one thing to really look out for is this has been put into the code as an excise tax in Chapter 42. And so the immediate reaction from some of my tax geek EO friends was, oh my gosh, it's an excise tax, I can't pay this is a cap on compensation. I don't think that was intended. I think some people worry about that. I think some people's organizing documents, bylaws, or insurance policies may have language to the effect that they can't do anything that would incur an excise tax. And you'll need to look at that language and try if you need to pay over $1 million to be competitive, I don't think there was any intent in this bill to say you can't do that.
Right.
It's just to put you on an equal footing with this.
So going to the other end, mileage reimbursement and regular travel expenses, subject to tax or not? No. That's reasonable business expenses, that's still excluded income. But to tell you, a lot of nonprofits provide parking. And, and that, if that regulations come out the way we think they are, we're gonna have to start paying excise tax on the parking that we give to our employees. I know one employer already who's not a nonprofit, who the day after the law passed, called all the staff into the office and canceled all their parking because he didn't want to have to pay taxes on it. So just 70 employees lost their parking that day, and I think he gave them a small little bump in salary, but it wasn't equal to what the parking cost. But now it's been passed along to all his employees.
And it's clear that if you are buying parking from if you're paying out of your pocket for that parking, that's a qualified transportation for your benefit, and the amounts that are paid or incurred, if they are not deductible by for-profits, you have to pay tax on that. I think where the ambiguity comes in is if you bought the building and the parking facility and depreciation of it, that's not mentioned over in 274 anywhere. So it's not clear how that's going to come out for for-profit employers, so therefore it's not clear how it's going to come out for us.
I've got a couple more questions here, but if anybody else has a question in the audience, if you haven't texted, if you want to just raise your hand, there are mics and we can get the questions answered. We've mentioned briefly, and it was just in passing, and this is not the new tax law, but a lot of the organizations here receive grants from donor advised funds. And if you haven't seen this, there are proposed regulations on donor advised funds that we alluded to. Could you just highlight the 3 areas that they're looking at on donor advised funds and how that may impact the nonprofits in this room?
Sure. And to be real clear, this is a notice that came out in early December, first week of December, could have been lost with everything else going on. It's a notice telling you that they're intending to propose regulations. And it's a little unusual in that it tells you that they intend to propose a couple of things. One would be, and the two very specific things are the 2 biggest questions that we're always flooding in: bifurcated payments and donor pledges. Occupy a lot of time for advisors. And the question there is, what is a more than incidental benefit to a donor of a donor advised fund, which is prohibited, basically, and an excise tax is paid if a donor gets more than an incidental benefit from advising a distribution. And if the community foundation goes along with it and the sponsoring organization goes ahead and does it knowing that it's a more than incidental benefit, then they can be taxed as well. And there are 2 questions in that area came up often. One is, when you have one of those events, right, where the ticket is $200 and the chicken dinner value is $50, and the donor wants to go, wants that ticket, can the donor just give the $50 part, the part that wouldn't be deductible under 170, and advise a distribution from this donor advised fund for the other 150, the other part? And the IRS came out and said, we intend to propose regulations that says no. That donor would get by going and listening to that private concert from U2, if that's what's going on there. They couldn't do that only paying the $50. They would have to pay the whole $200. So the donor advised fund distribution would be a more than incidental benefit. Can't do it. Have to pay for that ticket. The donor has to pay out of his own pocket. Second question was, can the donor advised fund just make a distribution that satisfies a donor pledge? And in the private foundation context, where also private foundations can't do the bifurcated payment, can't let donors have benefits, and a very strict rule under 4941 There's an old ruling that says a private foundation can't pay the legally binding pledge of a substantial contributor. That would be a violation of 4941. Every indication would be that IRS thinking, because they said, no, you can't do the bifurcated payment, that's a more than incidental benefit. You would think that paying a donor pledge would also be a more than incidental benefit in the eyes of the IRS. And there's some hints that true in their heart of hearts, that's what they believe. However, because the sector has given a lot of comments in this area, there's a softening of the position, the proposed position in this notice. And they say, if the distribution goes from the sponsoring organization to the donee organization, it doesn't say anything about a pledge, and if that donor doesn't get any other benefit, and if that donor doesn't claim a deduction for the amount of that distribution, even if that distributee organization gives them in error a receipt, then it's not going to be viewed as more than incidental benefit. So some people said, whoa, that's great, we can pay our pledges through our donor advised funds. I'd say, whoa, hold up. I think there's enough in this notice, if you read it carefully, to think that IRS doesn't think that that's okay, but they have heard the sponsoring organization community and the legal advising community that told them very clearly, we don't know what a legally binding pledge is, and it really depends state to state on state law. And besides that, how's the IRS going to figure that out? We have trouble figuring it out. And there are people out there that have been doing workarounds for a long time, so not pledging to give $50, but pledging to make a request that a distribution be made, and they get around it that way anyway. So there was really a trap for the unwary there, and I think the IRS recognized the administrative burden that it would put on sponsoring organizations.
Yep.
If they had to ensure that no charity that they made a distribution to had somehow gotten a pledge over the years from that same donor, they don't have that information.
Right.
So they say that in a private foundation context, still private foundations can't do that, but there's a difference in the relationship between a private foundation and their donor and the sponsoring organization and all of their donors. So they're not going to put the administrative burden on you.
Currently, what they're proposing is basically boils down to a don't ask, don't tell policy. Okay. You can tell us, my staff, that you should make a grant, to pay pledge X, with like the number, and as long as we don't put pledge number on it and send it over, it's okay. But if I
I would not encourage people to pay their pledges
No.
through these things, because it's just, it could look very bad if it starts
The
happening.
last one I'll just kind of really quickly go over is that there has been concern apparently raised with Treasury about the 2% floors being avoided for public support from donor advised funds. Okay, so what this means is that, as you may all know, is that you have to get 1/3 of your support from a broad group of donors. And any gift is more than 2% of your giving for the year, you have to only count as public support the 2%. Everything else is counted in your gross, but not in the 1/3 part. What they're actually proposing is that people are going to be using donor advised fund grants, which are treated as public support, to avoid that rule. So they're going to ask that you all track that this money came from a donor advised fund, but also that family gave me money over here, and I have to aggregate it for the 2% more. So that will add to your administrative burdens of managing your gifts coming in. We mention these because they want comment. Remember that thing about commenting? They want comment by March 5th. So if you want to voice your concerns about this, you're not nonprofit, or you're elated about it, you have to March 5th to make an opinion known. Okay. Is there any impact on non-U.S. based donors?
Not to my knowledge.
Not to my knowledge
Thought
either.
about it.
It's I think everything's the same. Okay, we got a question over there. Yep. Hi, George.
Hello, Ron. So we've all been drowning in the details involving this tax act, both resolved questions and unresolved questions. But I think the sector also has to take some bigger, broader views about what this tax bill could do for philanthropy, or philanthropy, I should say. So some of us have been worried about, given the nature of raising the standard of deduction, given the fact that the wealthiest seem to be able to wind up with more money in their pockets, and that might result in a greater capacity to give. Should our sector be concerned at all about what some of us are calling the potential gentrification of philanthropy in this country?
Yeah, I think so. There have been studies that show that givers along the income spectrum give differently, and that social services organizations, that lower income folks will give more as a proportion to social services organizations. Folks at the higher end of the spectrum will give more to museums. Not that anything is bad, but the mix of donations could change as the incentive is felt only by the higher incomes. I think also the influence of, folks are responsive to their donors. I think there's some concerns there that if you're not having the mix of income in the donors, that maybe there will be a tilt in the influences on the organization. But also, I think organizations are influenced a lot by their boards. And donors are not the only ones that should be on boards. I think you can look at how your organization is influenced also by, I think you need to be proactive, and I think you're right to be thinking about it. I think we should be thinking about how do we maintain mission focus, and how do we maintain the whole of the sector, even when some of these incentives may skew where some of the dollars go. It's hard to anticipate exactly how this is going to work. I'm more concerned about some of these taxing and the taxing endowments in particular. It is just mind-blowing to me, but it is not surprising given some of the anti-endowment thinking that I've seen on the policy side for the last 10 years, expressed through payouts that are higher than can be sustained, and expressed through the willingness to add payouts and distribution requirements. Like, there's a proposal that donor-advised funds have to distribute all of their contributions within 5 years of getting them, and a very anti-endowment bias, which I think could be really terrible for the sector. If we can't build up assets that can sustain the sector and the work of the sector through ups and downs of economic times and ups and downs of donors, it's things like endowments that help offset the need to have the day-to-day donations and help bring balance. I think we really need to guard.
Okay, we'll take one more question, and then we're going to wrap it up. We'll hang around for a few minutes afterwards. I agree, George, is a great point, and I think it's also how we manage our nonprofits and how we make sure that everybody's included in that process. It's kind of what Ruth was alluding to. How do we make sure that everybody still has a voice? And that's very important for us all to consider. Thanks for bringing that up.
Thank you. You've talked a lot about academic institutions and health and human services and several of the other sectors. Have you looked at all at how this is going to affect those of us in the environmental community, in the natural resource community?
I haven't looked at it specifically. In the environmental sector, you got a big bonus in the making permanent of the incentives for conservation easements to be contributed a few years ago, and I think mostly those are not going to be hurt too much because those are large dollar contributions that will most likely be above that fence, right? Folks are going to be itemizing. But other than that, I didn't see anything in particular. Was there anything that you saw that was particularly concerning?
No, I think you're right that many of those contributions are going to be above the fence, although actually many of our easement donors are regular folks like me. And so the breeze is getting further and further away. So, we have to rely on the focus on charitable intent or personal values,
right.
Mission and values. But since the environmental sector gets about, what, 3% of all charitable dollars, I'm interested in how this is all going to affect us in the longer run, because many of our donors are sort of the rank and file civilians.
Right. I have not seen a single study that's kind of broken it down by sector. What it tends to be is, you know, the size, what your typical donor look like. Okay, if you rely a lot on people that don't itemize right now because you have that long tail, a lot smaller, they're going to still give because they've been given to you already. Okay. My concern is a personal, I had no study to back this up. When I started to rationally think about it, is that group that goes from being an itemizer to a non-itemizer, that group has some decisions to make, okay? More so than probably a lot of other people. Above that, if you're still making a $100,000 gift and you're itemizing, then it becomes that tax elasticity. So I'm going to make it a $100,000 gift, or I'm going to make it a $90,000 gift because of the impact. It'll be an impact, but I think it's that and. Now that's just my personal observation. You bring up though an interesting question as we talk about these slippery slopes. And again, this is not to say, you know, the sky's falling, but these are things that we all need to be conscious of and continue to be aware of in the nonprofit sector. A few years ago back, there was actually a proposal that the only charitable deductions that would be allowed is if you gave to homeless shelters and food banks, social service agencies only. There were people that wanted to get rid of deductions for environmental groups, for arts, for education, all right? Because people in most need were the ones that needed charitable incentives, was the rationale. And my comment on that is that all philanthropy is good. Direct giving, great. Endowment giving, great. Foundation giving, great. Corporate giving, great. You know, I may want to support children, but I'm really glad someone's supporting clean water because I like to drink. Okay, I like to breathe. So we should all promote philanthropy generally, and I think that's why we should be part of these membership groups, maintain conscious vigilance as to what's happening to the sector, and as Ruth said, be a little bit of a squeaky wheel every once in a while because we're doing good stuff. And I thank you all for doing the good stuff. Community Foundation, we rely on you all to make, we make grants, we support you. You're the ones on the front line, and we can't say more than enough times, thank you for all the good work you do. And thank you for coming today and attending this session, and I hope it's been informative and helpful. So, thank you.